Okay, this is Bernadette Davis of J Group 3 International, also PHP Agency. How are you guys today? This is going to be what we call the Cash Value Insurance Basics 101. I'm doing this also for a training video for my team, but also for you that may be wanting to know what and how a cash value life insurance plan works and what it can be used for. Especially if you've been following along with me as we've been advertising our company, PHP Agency, as well as the products that we have to offer to help you establish and create wealth for yourself and your family. So hopefully this will answer some of your questions. It's very basic, very short. It won't take a few minutes, but a few minutes to go through it. And hopefully I'll be able to answer some of your questions that you have about how an index universal life or universal life or even a whole life policy works to help you create wealth for your family and yourself. Okay? I'm going to be referring back and forwards to a chart of information I have, and also will leave a link where you can contact me directly and ask me any questions you may have about the life insurance plan that you may have or you might want to get, and hopefully I'll be able to answer those questions for you. Okay? All right. So we're going to basically talk about a cash value life insurance plan. Most of us know we have term life insurance. We may have whole life insurance. We may even have what they call burial expense insurance, which is basically a whole life plan. Most of the time, it's a whole life insurance policy that has cash value buildup allowed in it. A small amount may accrue over a short period of time for as long as it stays in force. Okay, some of you may have the index universal life. Those are plans that, well, they actually work where they provide coverage for you, as well as allow cash value accumulation to occur in the policy at a set amount of rate of interest that's established by the insurance company and the industry, financial industry as well. Okay, and then there are those of us that have maybe an annuity. Annuities is a certain type of insurance plan, just work a little different. But most of what I've just said to you is basic whole life or basic life insurance policies. Okay, the difference is what we're talking about today is a plan that actually allows the policy to accumulate cash at a certain rate of return. Okay, so the cash value life insurance plan is also known as permanent life insurance. Okay, what it does, it includes a death benefit in addition to cash value accumulation, which we just established. Now, there are things called a variable life. Variable life insurance plan is a policy that operates based on market rates of interest. Stocks and bonds, think stocks, bonds, funds, mutual funds, things like that, because it works with the market. As the market go up, the rate of return goes up, goes down, it goes down. Okay, so it's more or less one of those kind of things. Call it variable because it can be up to date, down to low. Okay, while whole life, variable whole life, universal life policies all have built-in cash value, of course, you understand term life does not. Term life is just a basic plan of insurance. It has no cash value and is scheduled just for a term, hence term life. Certain terms, 20 years, 30 years, you have a level death benefit and you have usually a level premium. The only time the premium goes up is if you cancel the policy lapse and you turn a different year before the policy is reinstated. There, of course, is no cash value built in a term life insurance plan. They are usually the most inexpensive way to secure life insurance protection, usually for people that are just starting out in life, or young couples that are just starting out married and having children, or for people who just purchased a home and want to make sure that while they are living to pay for the home, in case something happens, the home life of the family can be provided for without financial loss or hardship. I think most of us understand that, okay? Now, once you have accumulated a sizable cash value, now we're talking about universal or whole life policy or index universal policy. Once you have accumulated a sizable cash value, you can use the funds in those policies to do a few things. Now, before I say that, go through those few things that you can use the cash value for. People have been maybe misunderstand. Some people misunderstand that it's not a trickery. It is not a new way of doing things. This method has been around for years. It's just that at some point in time, I think maybe 20 years ago, before the stock market crashed, those policies were racking in about a very high rate of return, about maybe 9 to 10% of return. And then there were some unscrupulous people that were using those products and saying that they were investment type products and misinforming the general public. Well, while it does aid in your investment, it is not an investment product because it's not, the universal life is just what it is, or whole life is just what it is. It's designed to provide protection. Okay, it does not operate like a mutual fund or stock funds. Okay, and licensing and federal regulations prohibit those of us who sell universal life plans or are not licensed to sell anything other than a life insurance or whole life plan, that we cannot say that a universal plan is an investment product. Okay, even though for all intended purposes it can be used as such. Okay, so you may have been on the back end of where somebody took advantage of you or somebody said something that was misinformation and you didn't understand. But yes, you can actually utilize the cash value policy accumulation that occurs in a whole life or universal policy. The difference between whole life and universal accumulation is the rate of accumulation of interest that it accrues at versus the way the whole life works. Whole life plans are usually a little bit more expensive. It's almost like you could say that, all right, let's say you got 3 cars. You have the top of the line car, in some people's book is Cadillac or Mercedes Benz. All right, let's go a little step further. Rolls Royce, Bentley. Then you have the Universal, which could be compared to, or can't say that maybe it's the Cadillac. And then you have your Term, which would be your Toyota. Okay, all of them are good products, but one outweighs and one works better than the other one. It has a better value built in it than the least one, which would be the Term. Okay, so those products usually, all of them rather, basically establishes a death benefit to secure against financial loss. That is the whole main reason for life insurance itself. Okay. Now the cash value that builds up in it, because the way the policies are made and created, is a plus. It's a positive. It's an advantage. All right. So what can you use those funds for? Okay, you can use those funds to pay out your policy premium. In other words, let's say that you have the policy, a whole life or universal, in force for 5 years. There is some cash value there so that you have not taken it out or loan against the policy. In case for any reason, and some of those, they call those provisions the automatic premium loan. If for any reason you were not able to make your premium, or you got disabled and you're no longer working, the policy can stay enforced by the actual premium dollars that have accumulated in the plan until it either expires or you're able to replace those funds when you go back to work. So that's a plus. So you can use the funds that's in the policy to pay a premium. Okay. You can also take out a loan. I just mentioned you can take out a loan, and sometimes a lower rate. Matter of fact, most of the time a lower rate than banks offer. Okay, because it's already built in and it's already at an interest rate that's occurring at. So you're just borrowing against the cash value that's built up. Some people understand that. Some of you looking already know that's what, because you've probably done it already. Okay, so that's an opportunity. That's a plus for you. That's an advantage. Okay. The other thing you can do, again, this is where my company comes into, and our job and my sales force as an agent. We are here to help you to create wealth by creating an investment portfolio that maintains and accumulates wealth. Okay, so you can utilize the funds in the policy to help create wealth. In other words, take the money that's in there and make the money make more money. Make money, make money. If I can say it just that way. Make money, make money. You can do that. You can do that. That's nothing trickery about that. There's no deceit involved in that. That is not a new process. Been around for many years. Just most people just don't understand it. They don't know that. But you can actually take a life insurance policy that's been taken out on your life to secure against financial loss in case of your premature death, and utilize it to create a living benefit. That's what we call it now. So life insurance, utilizing a whole life policy or universal policy, can create a living benefit in addition to a death benefit. Okay. All right. Then the other thing you can do with the cash value that's in the policy is to supplement your retirement income. Again, the idea is to take money that's accumulating and make more money. Okay, you can take that money if it's, let's say the policy's been in force for 15 or 20 years and it's a nice piece of money in there. You didn't have to borrow it, you didn't have to take from it. You can take a chunk of that money or a portion of it and you can purchase an annuity. That creates an additional income source for your retirement. Yes, you can do that. Yes, it's legal. Yes, it happens. It works. A lot of people do it. So this is why I'm here today to tell you about what it is that we're offering to you by way of an index universal life insurance plan or an annuity. We can provide those services for you through my company, BHB Agency. Okay? All right, so let's talk about real quickly how exactly does this accumulate in the policy? How does those cash value accumulate? Well, the details really would vary and is based on the type of policy you have, which we just discussed, and each individual life insurance company. Again, it depends on what company you're purchasing from and how it works. But typically, this is how it works generically in the process. Again, every insurance company or policy may operate or may work a little bit different than the other. Basically, typically, generically, this is how it works. All right, your premium payments are divvied up. Okay, that means when you make a premium payment on a cash value life insurance policy, a portion of the payment is allotted to the policy's death benefit, which is based on your age and your health and underwriting factors. The second portion of the premium covers the insurance company's operating costs and profits. Okay, now the rest of the premium payment will go towards your policy's cash value. So 3 allocations of the money that's in the plan, which is your premium, is used. One, again, the first part of it is allocated to the policy's death benefit. Okay? Again, I'm looking at a chart, so you may see me look away from the screen. The second portion covers the insurance company's cost to operate and its profit levels. You got to do that. And the rest of the premium that's in the policy, or that's in your payment, will go towards the policy's cash value. Okay? The life insurance company generally invests this money in a conservative yield investment. This is what we're talking about, a rate of return. Usually it's pretty conservative. Okay? As you continue to pay the premiums on that policy, the cash value in it is earning interest, more and more interest. You may have heard the term compounding. The cash value grows over years. Okay? So it doesn't happen overnight. It takes time for that to happen. Okay? The accumulation process will slow down over time. So earlier in the process, you can add in some policies, particularly the universal, you can add more money to it to help it accumulate faster cash values, bigger and faster cash values. The rate of return, again, is based on what the policy has set in, as well as the market. Okay? So, in other words, in the earlier part of the year, in the early years of the policy, the higher percentage of the premium goes towards the cash value. Okay? Over time, the amount that's allocated to cash value decreases. So it takes a little while before it starts to decrease. It's similar to how a home mortgage works. Basically, in the early years, you pay most of it, your mortgage is going towards interest, while in the later years, most of the mortgage premium or payment rather is going towards the principal. So that's basically how it works. Okay. Each year, as you grow older, the cost of insuring your life is more expensive for the life insurance company. This is why the older you are, and which some of you may have questions about, why is the policy, me taking out insurance at 55, costs me more now than it did 10 or 15 years later? Well, the older you are, the more it costs to purchase a policy, particularly a term life policy. When it comes to cash value policies or insurance, the insurance company factors in these, which they do, they factor in those increasing costs. Basically, age. Okay? That's just the way it's written. That's just the way it is. You really can't explain that. Okay? In the early years of the policy, the larger portion of your premium is invested and allocated to the cash value account. Okay? Generally, these cash values, they grow quickly in the early years of the policy. Then in later years, the cash value accumulation slows down as you grow older and more of the premium is applied to the cost of insurance. So that's basically how the cash is accumulating. Slow in the beginning, speeds up, and then slows down when you get older. All right? Now, different policies accumulate cash value in different ways, and we're going to talk about how that works. Different policies accumulate cash value in different ways. That could be different policies, as in how a company is marketing a whole life plan or a universal plan. Then you also will start to hear the term index universal life. That has a certain amount of interest accumulating based on market rates. Okay, so different plans now. So we're still talking about cash value plans. The only plans of insurance that will accumulate cash is a whole life or universal life. Those are basics. Term does not accumulate. Okay, whole life policies usually provide a guaranteed cash value account that grows according to the formula the insurance company determines. Again, it's left with the insurance company, so that's why I'm talking in generics. I just can't give you a direct number because every policy may be written differently. Universal life, again, universal life policies, they accumulate cash values based on current interest rates. That's the difference. The whole life, let's go back over that. The whole life has a guaranteed cash value account that grows according to a preset factor that is set by the insurance company that's writing the policy, underwriting the policy. Universal is based on their cash value accumulation is based on current interest rates. Okay. Variable life insurance plans, which you may hear variable universal lives, or you might even hear variable whole life. Those companies invest funds, those policies rather, are in funds that are invested in sub accounts that operate like mutual funds. And some of us are familiar with mutual funds. Cash value grows or falls based on how well those sub accounts perform. You heard me say earlier, it's up and down. One day it could be up and down because it's based on market rates. Okay. Step by step, this is how it works. Cash value grows. How cash value grows in your whole life or universal policy. Step by step. All right. Let's say you purchased a whole life policy with a $1 million death benefit when you're 25 years old. You consistently pay your monthly premium, and every month a percentage of that payment goes towards the cash value of the policy. 30 years after you purchased the policy, you're now 55 years old, and your cash value account has grown to $500,000. That's nice. Because the policy offers a $1 million death benefit, and you already have a cash value of $500,000, the insurance cost must cover the remaining $500,000. Okay? 10 years later, your insurance policy, your cash value, has grown to $750,000, provided you didn't mess with the money before. You didn't take it out, and your policy didn't lapse, and it didn't disappear. 10 years later now, first it was 25, 30 years later, 55, you got $500,000 in that policy, cash. And then now, let's say you left it there, and 10 years later, now you're 65, $750,000 is in that policy. Now, you're 65 years old, right? The cost of insuring your life now is higher. However, when you factor in that significant amount of cash, the policy is really only insuring $250,000. So that's where the cash value is there. So instead of insuring $1 million, it's only insuring $250,000 of that. The rest of the death benefit the policy will pay will come from the cash value. Okay. Now that's very simple. The numbers can vary, basically depending on the insurance company that's writing the plan or the type of policy that you purchase. In some cases, which would be a universal, will be based on the current interest rates. Here, again, today I just gave you some basics. The bottom line is this. You want to talk to your insurance advisor agent. If you don't have one, I'll be glad to help you. Or someone local can reach out to you to determine how to calculate potential cash values that accumulate in a permanent life insurance policy. Permanent life insurance policy, again, guys, is a whole life plan or a universal life and or an index universal life. Variables come into place too. All right, we haven't talked about variables today, but that's a different type of insurance plan. But basically, those that accumulate cash values. The cash value in the policy, remaining in your policy as your death benefit, goes back to the insurance company. Okay, that's basically it. Yes, sorry. All right. So we've actually, and again, if something happens, I'm sorry for the interruption. If something happened, then to you, and you're the insured, then your family will receive that cash value and the amount of the death benefit. If the policy's been in place for a long time, usually what will happen, the cash value will be added to the death benefit. So when the person dies, then instead of them getting a portion, they'll get the whole amount plus the cash value that's in it. Okay. So you want to talk to your agent. You want to talk to those that are professionals. They'll be able to sit down and go over some typical examples and illustrations with you on how those work. Or if you already have something in place and you're not sure about how it works, reach out to your insurance agent. They'll be glad to assist you with that. I'm certainly sure. I hope this has been somewhat of a way to help you understand the basic of life insurance plans and how cash accumulation works in those plans. Again, my name is Bernadette Davis with J Group 3 International, also part of the PHP agency and licensed insurance agent here in the state of Florida. Thank you so very much. Have a great, wonderful day.